Hello, good morning, welcome back. Today's Casual Friday in the cold Northeast, so no tie. So today I wanted to talk a little bit about the landscape of the competition out there today. So a lot of people refer to the brokerage shops as, quote, platforms. They'll also look at the business model, and there are different types of business models, and that's what I want to talk about today so you know what to expect if you're either out there looking for position at one of these companies or you're competing against one of them. So there are some pluses and minuses, and there are some not obvious scenarios that you should know about, so you can either you can get into it with your eyes open, and that's hopefully of value to you. So the first platform I'd like to discuss is the what's called a pure play mortgage brokerage shop, commercial real estate mortgage brokerage shop. And that is one like Silver Thread Capital, not owned by either a bank, not owned or embedded in a commercial real estate brokerage shop or a residential real estate brokerage shop. The advantages, there's one main advantage. We're able to solicit business from brokers, from different brokerage shops. We get a lot of business from commercial real estate brokers. If we were embedded in a brokerage company, we would really be limited to doing business with those agents. You can imagine how awkward it would be and sort of a maybe lack of trust if we were carrying a card of a brokerage company and we were soliciting business in another brokerage company. And I know this firsthand. And it's very, very difficult to walk into another brokerage company and say, hey, we don't share information with the sale brokers or the leasing brokers. We're sort of a different division. That sounds great, but unless you really, really have trust with those other people that you're trying to solicit business from, it's a very difficult way to get business. And so one of the other downsides is if you're in one of those shops, and for whatever reason you're not producing because either the leads aren't coming through that shop or maybe the folks in that shop are using your buddy at the next desk because they've known him or her for longer than you, or the type of business they're doing is just not really the kind of business you want to be doing. For example, maybe that company's doing just small deals, or maybe they're doing just the deals are too big for what you want to focus on. So there are lots of different things you need to look at if you're going to join a platform that's embedded in another larger company. The upside, of course, is if you become, and in sales, this is somewhat the brutal truth, there's sort of an 80-20 dynamic going on. 20% of the personnel produce 80% of the results. The ratio could be a little bit different, but you'll always find that there are star performers in every sales organization. So if there are 10 mortgage originators in one of those embedded shops, you can bet that 2 or 3 or maybe 4 of them are the top earners because they have somehow, through sheer competence, through perhaps nepotism, perhaps oh boy network, whatever reason. I know that sounds negative, but this is the reality of it. But I did lead off with saying pure competence. That the 3 or 4 or 5 of the 10 will be getting the lion's share of that business. And if you're new in that shop, it's going to be very, very difficult for you. It might take 2 years for you to pop through and start doing deals on a flow basis. So you just need to be aware of that if you're just starting out. Of course, if you're not, and if you have a book of business and you're moving over to that other brokerage company, well then fine, then that's not relevant for you. But if that were true, you're probably not watching this video. The next type of competitor that I'd like to mention is what's called a correspondent shop. So correspondents spend a lot of their time trying to place loans with a group of insurance companies. So the traditional correspondent model is insurance companies that are lending money, that are actually making mortgages. The insurance company is in the insurance business. They do not want to be in the origination business. They will make loans, but they don't want to service those loans, and they really don't want to go through the solicitation process that we go through. They sell insurance, they collect premiums, and in that bucket of money that they have to invest it in various ways. One of the ways is by making mortgages. Correspondent shops have grown up from that business model through the business model of the insurance companies wanting to put money out. And what has happened is the correspondent shops essentially have a license, if you will, that says, hey, the originator or the correspondent is the only one in that region, that zip code, that county, that multi-county region that can accept and look at deals and submit deals to the insurance company that they're tied to. And usually a correspondent shop might have 8 or 9 or even 10 different insurance companies that have a little bit of a variation on the theme of the products that they offer, the loans that they offer. And if you call one of those insurance companies directly, they'll route you back to that correspondent shop, which is fine because in many cases the correspondent shop will do a lot of the work. The big difference is, of course, they need to earn a fee. So you'll either be sharing a fee with them, which could be good or bad, but basically you're giving your client away because after they make the loan, they service the loan. Again, the insurance company doesn't want to be in that business, so the correspondent shop model is they have this fixed group of insurance companies that they do business with, and they might have 100 million or 200 million or $1 billion loan portfolio of loans that they've made that they're servicing, and they make a little bit of strip of income from that servicing portfolio. And of course, they're collecting the mortgage. They have a relationship. They have a built-in relationship with the borrower. I mean, sounds great. Truth is, of late, the last few years, because interest rates have come down and because there are many non-regulated groups, non-regulated institutions that have jumped into the lending market, between those and the banks whose rates are now low. It's an extremely competitive marketplace, and the insurance companies tend not to be fierce competitors. They generally are conservative lenders, maybe 60, 65%, maybe 70% loan to value. The rates may or may not be, depending on the shop, depending on the insurance company, be competitive with banks. And so they may not be the best alternative or money source. So while it sounds great, the correspondent shops do, and it's sort of this nice, maybe cozy relationship of built-in business. On the other hand, at times they're really not that competitive. In my experience, when I've interviewed and actually have hired people from correspondent shops, what has happened, and again, this is the reality of it, a correspondent shop will hire someone or 2 or 3, and the pitch is, hey, I own the shop, myself and my son or my daughter and my 3 buddies. We've been doing this for a very long time, and boy, we're doing all this insurance company business, and we have all this other business that we're sort of turning away. You come join us, and you can have that other business that we've sort of turned away. And that sounds good, and I'm sure it works in some cases. What I've seen in my experience when I interview people who are not so happy in a correspondent shop is that that other business that's being turned away doesn't fit the insurance company model. That's why it's being turned away. And you're thinking, well, I'm going to get those leads. The problem there is generally your split is going to be 50-50. And you're sort of alone because all the other people around you aren't really in the market other than the insurance company market. So they can't really help you just share information, share stories, share knowledge about what other lenders there are out there that might, for example, be doing loans that don't fit the insurance company bucket. They become sort of I don't want to say dull to the or not competitive, but they've sort of become not competitive with the greater market and all the different lenders. It's a very dynamic, all the different lenders coming into the market, who's doing what the programs are, how they're changing, what some of the idiosyncrasies are. So while it sounds good that you might go into one of these shops and be sort of the guy or the gal who gets the leads from from the other folks who aren't doing those types of deals, you have to watch out. Is that really where you want to be, especially if you're on a 50% split? At the end of the day, when you get down to it, you have to look at how much money you're giving away and what type of support you're getting in return. So far we've gone through the pure play standalone shops like Silver Thread Capital. We've discussed a little bit about the correspondent shops and some of what you need to look out for there. You also should be aware, and I've mentioned it already, of the embedded shops, the embedded platforms. So at CBRE and at Marcus and Millichap, these are sort of companies within companies. At Marcus and Millichap, it's called Marcus and Millichap Capital Corporation. I was with Marcus and Millichap Capital Corporation. Prior to that, I was a Marcus and Millichap executive, and I was also a sales agent. So I know that system pretty well. And the way it started out was they're going to have one or two mortgage originators in an office, and they were going to, get leads and get business from these other folks in the office. And it sounds good, and it worked to some degree, and it still works. They've grown magnificently as a company, and the Marcus and Millichap Capital Corp can be a force because a lot of those businesses are doing very high volume. If someone is competent in that office, they're doing very, very well, getting a lot of business. But again, in that environment, proving competency and proving trust is number one priority. A lot of the brokers there are extremely competitive, and they're not going to just simply give you their lists of clients. It's just not going to happen. You have to prove yourself out. If you do, over time, then it could be a very lucrative situation. I can't really speak to CBRE because I've never been in that shop, but from what I've observed and when I was competing against them, and I do compete against them, they have a division that does lending. They have a little bit of an advantage in that they have an agency license. In other words, they are licensed, if you will, to make loans for the agencies, for Fannie Mae and Freddie Mac, which means they are making credit decisions internally at their shops, which Marcus doesn't do. Marcus acts as a broker by trying to place loans with the best lender at any given point in time, whereas CBRE, if it's a multifamily, can actually their lending division can actually make credit decisions. A little bit of a difference, but again, you get the point. It's an embedded shop, and I think they do bigger deals than the Marcus team. So that's the third type, the embedded type. Sort of an outlier and something you need to look out for are those lenders that purport to lend directly. These are generally not banks. They might be, quote, specialty lenders, opportunistic lenders, and you sort of have to understand, are they just purely lenders, or do they, if they can't lend out of their own book, do they also act as brokers? You have to be very, very careful. In the Northeast, what I had found when I came back from California was that lenders, if they cannot do a deal, will, unless you tell them not to, some, not all, will share that information with another lender friend of theirs. It's called a lender turn down. And a deal that they're turning away, they will give it to a friend to either ingratiate themselves or whatever. I'm not making any accusations, but I have found that the lender turn down lead generation model is alive and well in some areas of the country. It wasn't in Southern California when I was brokering there, but it seems to be a way that in the back of the minds of some of the bankers here and some of the non-regulated institutions here that that's a way to do business. Of course, it's something you just need to be aware of, and you need to either ask if they do that or instruct them not to do that because you don't want to lose your client. If of course, if the client is yours to begin with, and by that I mean you have a signed agreement. So that's an overview of the different models you'll see out there. Each has a positive, each has a negative, and I encourage you to just do your homework, do your diligence, and that's it. Good luck. See you on the next program. Bye-bye.